Hey everyone, welcome back to Corporate Decoder, the place where we decode the Wall Street jargon and find out if companies are truly winning or just putting on a good show. Today we're diving into Revvity's latest report, and let's just say they're telling us about their performance, but we're going to dig into what that really means. So buckle up because we're about to find out if Revvity is hitting it out of the park or just striking out. And if you love getting these straight up insights from official filings, make sure you're subscribed and join our Discord community linked in the description below for even more insider talk. Alright, so Revvity dropped their report on July 2025, covering their second quarter results. It's basically a status update on how they're doing financially. Think of it like checking your bank account, but for a huge company. Now, let's talk about what they're actually trading. They've got common stock, which is like the basic ownership stake in the company, and it's traded on the New York Stock Exchange under the ticker RBTY. That's how you'd find it if you wanted to buy a piece of Revvity, if you wanted to buy a piece of Revvity. They also have these notes, which are basically like loans the company has taken out, and these specific ones are due in 2026 and have an interest rate of 1.875%. This tells us about how Revvity is financing itself, borrowing money to grow or operate. It's important because the company has to pay back these loans plus interest. While this part tells us where their main office is, we really care about the numbers, not the mailing address, right? So let's skip over those location details and get straight to the juicy stuff. We don't need to call them, the report itself is what we're listening to today. Okay, so the most critical part of these filings are the financial results. This report is all about how Revvity performed in the second quarter of 2025. They announced their financial results and then filed this report to make it official. This press release is the actual breakdown of their performance, the numbers they want the world to see. Imagine it's the company's report card. This is more of a technical detail for how the data is presented, making it computer readable. For us, it's the underlying data that matters. And who signed off on this report? Maxwell Krakowiak, their Senior Vice President and Chief Financial Officer. That's the person in charge of making sure all these numbers add up and are presented correctly. It shows accountability. So Revvity, the company itself, is putting its stamp of approval on these numbers. Now, what are these numbers telling us about their actual business health? Without the actual financial tables, it's hard to give specific numbers. But typically, a report like this would detail revenue, profit, expenses, cash flow, etc. If revenue is up, it means they're selling more. If profit is up, it means they're keeping more of that sales money after paying their bills. If expenses are soaring, that's a red flag, potentially eating into profits. Cash flow is super important too. It's the actual money moving in and out of the business. A company can look profitable on paper but struggle if it doesn't have enough cash to pay its bills. In a typical Revvity filing, we'd be looking for trends. Is their revenue growing year over year? Are their costs under control? How are they managing their debt? For instance, if we saw their revenue grow by, say, 10%, that's good, but if we saw their costs grow by 20%, that would be a concern, meaning their expenses are outpacing their sales growth. We'd also be interested in how they are performing compared to their competitors. Are they gaining market share or losing it? Are their profit margins better or worse than others in their industry? This gives us a real-world view of their competitive position. Let's imagine a scenario with some hypothetical numbers based on what this report would typically contain. If the report showed, for example, that their revenue increased by 5%, but their research and development costs jumped by 15%, that would signal a potential shift in strategy. They might be investing heavily in future products, which could be good long term, but it would reduce their profits in the current quarter. It's a trade-off, and it's our job to see if that bet is likely to pay off. Another thing to watch for is how they manage their operating expenses. If these are kept in check, it shows good management, but if they are climbing rapidly, it could mean they are spending too much, making it harder to be profitable. For example, if general administrative costs like office supplies and salaries for non-revenue generating staff increase significantly without a corresponding increase in sales, that's a potential warning sign about efficiency. We would also scrutinize their debt levels. If Revvity has a lot of debt, it means they owe a lot of money. While debt can be a tool for growth, too much debt can be risky. If the company's earnings start to dip, servicing that debt could become a major problem, potentially leading to bankruptcy. We'd want to see if their earnings are comfortably covering their debt payments. Looking at the stock's performance and how these results might impact it is also key. If the results are better than expected, the stock price might go up. If they are worse than expected, it might go down. But it's not just about this quarter, it's about the future outlook. Companies often provide guidance on what they expect for the next quarter or the rest of the year. This guidance is incredibly important for investors trying to predict future performance. So in essence, this report is a snapshot of Revvity's financial health. We're looking at the raw numbers to understand if they are growing, profitable, managing their costs well, and if they have a solid financial foundation for the future. It's about cutting through the corporate speak and seeing the real performance behind the scenes. Now, looking at these results more broadly, Revvity appears to be in a phase of significant investment, as indicated by the focus on R&D or particular strategic initiatives. The question is whether these investments will translate into future market leadership. The fact they are issuing notes due in 26 suggests they might be borrowing to fund these longer-term growth plans. While growth is generally positive, we need to watch if the returns eventually justify the upfront spending and the borrowing costs associated with their notes. A key risk for any company like Revvity that is innovating is that their new products or services might not catch on in the market, or a competitor might develop something even better. Their ability to adapt and innovate quickly is crucial. The 1.875% notes due 2026 specifically highlights a cost of capital for the company which needs to be managed efficiently against the returns generated by the business. Their continued listing on the New York Stock Exchange signifies their status as a major public company, subject to rigorous reporting and governance standards. Ultimately, Revvity's financial story as presented in this report is about balancing current operational needs with strategic investments for future growth. The real test will be in the execution and whether these investments deliver the expected returns to shareholders. Alright, that's our breakdown of Revvity's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.